1 year ago today, European investors woke up to the news that the Dow had seen one of its largest declines ever. The world watched as the benchmark index plummeted by 774 points in a single day. Now, a year later, markets have begun to recoup much of the loss that was seen over the course of the credit crunch. While investors, they've been experiencing a September slump, or they were expecting a September slump, none of that ever happened. What happens now that September is coming to a close? We've got, half a day of trading left. On the debate, though, for where the markets are heading from here, we have Espen Bårdsen, an analyst from Eclectica, Piers Curran, head trader at Amplify Trading, and Derek Halpenny from Bank of Tokyo Mitsubishi, still with us in the studio. Welcome to all of you. Piers, you're the newcomer. We've never actually had you in the studio. Welcome.
Thank you for having me.
Let's start with you then, because also you think that this whole W-shaped recovery that some of us could be looking for, i.e. another leg down, that has already been there. We just haven't even recognized that it's been there.
Yeah, I mean, I think a lot of investors have got it badly wrong. If you're waiting on the sidelines for another correction lower, you know, it's been expensive waiting there, and it's going to continue to be expensive. I think if you actually look at the charts, you know, on an annual basis, that first leg lower into the lows at the beginning of November, and then the retracement up to the back end of 2008 was actually your first V. Then the overextension, the oversold situation we got in the pricing in of the depression in February, that's your second V. So if you want a W, it's there.
I guess, I mean, I'm glancing, I can see a couple of W's, but then again, yeah. I'm not a technical analyst either. But Espen, you're saying that you need to be a little bit more cautious in these markets. However, I'm assuming that while you're saying it, you're not, I mean, you're still buying the market. You can't not be buying.
For a hedge fund, no. Definitely not really invested in equities. Don't really think that's the place to be over the coming year or two. Rally has been incredible. It's remarkable, and obviously it's been painful if you missed it. But I really think now to start with fresh cash is kind of a dangerous area. I think Pierce's point about W, I think he's referring to obviously the stock market movement. Yeah. I'm talking, I mean, in terms of economy, the economy clearly hit a V and then has come back. The question is where it really goes from here. I don't think you're going to have the biggest country in the world in terms of economy, the United States. I don't think the consumer there is ready to start breaking out their credit cards again. Not only do they not have the capacity to do so, no one's going to actually give them the credit card in terms of credit creation. So I think you're going to see aggregate demand within the world economy still quite weak. The Chinese have thrown everything, all the money in the world at their issues, but they're just going to have more overcapacity on top of more overcapacity. I think that's going to be a real issue coming later into 2010.
So you sound more cautious.
Definitely on equities, yes.
So we've got one that's a little bit more bullish, one that's a bit more bearish on equities, and Derek, you're coming at it from a currency angle.
Yeah, but I think an element of this is timing, and there's an awful lot on the market who are very skeptical of this move. But we haven't even had confirmation in GDP data in regard to the V part, the recovery from the collapse, and that's going to come, I think, in data that we're going to get for the third quarter and the fourth quarter, and possibly into the first quarter. So I think the markets or those in the market who are looking for a quick collapse from current levels, I think, are just maybe getting it a bit too soon. I think certainly I would have concerns come the summertime of next year, when clearly that is the time when I think monetary stimulus will be reversing, fiscal stimulus will be beginning to fade, and then the private sector real economy will have to stand or start to stand on its own 2 feet. And I think after an initial recovery, then we could get a downturn in the second half of next year.
Yeah, I think Derek hits it well there. Clearly the markets are already priced in. You're going to have strong growth this second half of the year, and perhaps even the first quarter. But clearly, once the stimulus ends, it's a different ballgame then. So.
But I mean, I don't think I'm bullish on stocks, for the next 6 months. I think we're going to hit some. There's plenty more upside to come. I think we should have this conversation again in 6 months' time, but I don't see a big correction lower, in the second half of next year. I see it flattening off, and possibly a period of consolidation or range trading for a period of time. I don't see a collapse in the stock markets.
Do you know what? Let's just get a couple more questions, and there are viewer questions coming in as well. Julia,
Yes, I'm just curious. I know, Piers, that you're more optimistic, but I'm curious, there's obviously a lot of debate on what will happen when the stimulus that the governments are pumping into the economy is withdrawn. Do you think the fundamentals of the economy will be there, so when the government stop pumping that kind of money into the system, that the economy won't react negatively?
Yeah, I mean, I think, the central banks have done an extraordinary job up to this point. They're only halfway through that task. They've navigated a pretty, a massive minefield, really. I'm confident that actually they can do the second half of the job as well as they've done the first. So, yeah, sure, the stimulus has to be removed at some point. I don't think that'll happen until, certainly Q2 next year at the earliest, and I see them removing it at a reasonable pace, and I don't see stocks suffering, as a result of that. I think when we come to that point in 6 months' time, I think the economy will be back up on its feet. The labour, it's all about the labour market, really, in the United States anyway, and I think that's showing an improving trend, and I think that will continue to improve.
Espen, this is Christine. I want to throw this question to you. You say you're not invested in equities. Aren't you afraid of missing out on the rally? And if you're not buying equities, what are you buying?
Well, bonds, for example. I still think government bonds, long-duration government bonds, are the place to be. I think there's enormous spare capacity in the world. I think places in Asia are creating a giant bubble in the form of building more and more capacity to manufacture goods, etc. And I think that'll wind up on the Western consumer's doorstep, and prices will fall, and trade protectionism will rise, and government bonds, particularly German long-duration bonds, will be in a very attractive place to be.
A couple of viewer emails are coming through that I just want to highlight. Jeff writes in, says, with most companies still having a shrinking top-line growth and are making their numbers solely on cost-cutting and the selling of assets, how are they going to maintain the E in PE when they've run out of costs to cut and assets to sell? So with that in mind, let's also just include another question. Greg writes in and says, regarding the W recovery, does speculation play a significant role in the overall recovery, or will the market eventually balance despite the extreme volatility? Two good questions. Where does the E come from in PE? And this W recovery, what role does speculation have to do?
Yeah, good questions. I think we're about to get Q3 earnings. They're right around the corner. I think, the market wants top-line growth. It wants revenue growth. And to be honest, I think it'll get it because, not only did the markets price in a depression in Q1 of this year, also it was priced in at a corporate level, and people, corporations cost-cutted, too much. They've slashed their labour costs. The inventory levels are at record lows, and now with new orders coming back in, there's that disparity between new orders and the record depressed levels of stocks has to be rebalanced. So.
There are a couple of emails also just saying don't underestimate the U.S. Consumer and the U.S. market's recovery, which was the point that you were pointing out as well earlier there.
Well, exactly, and there's so much to point out in the past where consumers come back to life at the worst point, or just after the worst point in the economic cycle, and there's every chance that we could get a good employment report with claims, example, where they are at the moment, and even with incomes where they are at the moment as well, you can still get a rebound in pent-up consumption over the short term. I would agree in the long term that the consumer in the US is not going to be the driver of global growth.
You're staying with us, so we'll leave it at that. Espen Bortson, analyst from Eclectica, thank you very much, and Piers Curran, head trader from Amplify Trading, thank you to you as well.